Hello and welcome back to the Property Pilot. I'm Marco Carusi. I'm a property investor, developer and mentor, and today we're going to talk about how to earn an income through investment property. We're going to talk about different strategies and techniques you can use to actually use property as a way to generate income for yourself. So first of all, we're going to talk about the most frequent one, where we invest in property to get a monthly rent, minus your mortgage and all your other expenses, you're left with your net profit. So we're investing in property for essentially for a monthly cash flow. And the idea here is to replace your 9 to 5 job, if you're working at the moment, with income via property. So I'll talk very briefly a bit about that first of all, and then we'll come on to a secondary, more active way of generating income through property. So let's do some basic maths. Now I'm going to make some assumptions. So let's say we're buying maybe a 2-bed buy-to-let, a very budget buy-to-let, beginner part of the market, great for rentals. And let's say we're purchasing this property for around £100,000, and rent-wise we're receiving about £700 per calendar month. Today's mortgage rates are going up at the moment, and they're very, very crazy. But you can get, a 5-year fix, which is quite a nice medium to long-term fix that allows you to accurately forecast your costs for the next 5 years. And you could be paying somewhere between, say, £300 and £500 per month, depending on the mortgage. Is the mortgage in your personal name or is it in a limited company? So let's just take the average. It'll probably be around 350 actually, if I think of an accurate average. So you're getting £700 per month in rent. You minus off your mortgage costs, which call it 350, and then you've got other costs to think about as well. So you've got maintenance, you've got your insurance, you've got voids, etc, etc, etc. Now for my portfolio, I allocate 10% of my rental income in a contingency fund to cover all those areas. In my portfolio, I have very minimal voids, at the most 2 or 3 days. I'm very quick at turning around my properties. In terms of maintenance, obviously things go wrong. There are leaks, things need upgrading. Your gas certificate needs renewing every single year if there's gas in the property. Every 5 years you'll need an EICR, which is an electric report conducted, and there could be remedial work that needs taken as a result of that. All these things need to be accounted for. And again, insurance. If it's a freehold property, you're legally responsible for insuring that property. And that's typically around 2%. The premium for your insurance is around 2% of the annual rental. That's a good way of working it out. Again, you go back to the figures. So we're getting £700 per month, minus 350 for the mortgage, minus 10% of 700. That's the 10% that I use, which is 70. So 70 plus 350, that's 420. 700 minus 420 is £280 per month. Net, that's you're making that pre-tax as well. So I hope you're following the maths with me. Essentially, every single property we're buying around this size, so maybe it's a 2-bed house that rents for around £700 and it's purchased around 100,000, we know we're making about 280, make the maths easy, £300 of profit per month. Great. Now you've got to work out how many of those you need in order to have an income that you actually want to make through investment property. So let's use some easy maths. Let's say you've got 10 of these. So 10 times £300 a month, that's £3,000 a month. So that's what you're going to be having as an income every single month. Again, that's pre-tax. Now, what you've got to understand a bit more in terms of that is cash flow. There will be some months where you take that £3,000. There'll be other months where, in fact, you make slightly more. Maybe you're getting a lucky streak and you're having very little maintenance issues. However, on the flip side, there will be months where maybe you only take £1,000. Maybe one of your boilers goes and it's time to upgrade that boiler. So what I'm trying to say is, every month may be slightly different. You'll have good months, you'll have bad months, but they should average out to around that £3,000 per month if you've got 10 properties. Now again, one massive variable here are interest rates. So if rates are to go down, then your profitability increases, and it increases drastically. But on the same wavelength here, if rates go up even further, then that profit is further squeezed. So this strategy and this concept heavily relies on interest rates. Now the second strategy that we can use to actually make an income through investing in property is maybe less reliant on interest rates, which again exposes itself to different kinds of risks that we'll talk about very shortly. This is more of an active role in property. The primary method that I've just mentioned is more of a passive way of investing in property. It doesn't actually take that much time. And even if you build a sizable portfolio, it really won't take as much time as a 9 to 5 job. Whereas the second method that I'm about to explain is a bit more hands-on, it's a bit more active. You'll be spending more time doing this, but typically speaking, the returns are slightly higher, obviously as a reward for your effort you're putting in. So this is when we're trading property, and we've got an active part in finding a property that's at a really good price point. Maybe we can negotiate a really good deal with an agent. Maybe you know an agent really well, you've been working together 10 years, and they know, they like, and they trust you. And most of all, they know that they've got confidence in your proposal and you can complete on that deal and you're not going to back out. That stands for a lot, especially in today's market. So let's say you've got a really good deal and you know you've got to carry out some works to a property in order to exit from this strategy. So this strategy relies on an exit. The most simple way of describing this strategy is finding a property that needs refurbishment, undertaking those works, and then either selling it or financing that property at the end of it, and you pocket that margin and that difference. Again, the second exit strategy, which is finance, again, that will rely on interest rates. But the first of those, you're exiting via a sale, selling that property on, doesn't so much rely directly to you as interest rates. Obviously, the person purchasing or company purchasing that property probably will get a mortgage on it. So in some respect, it's indirectly linked, but it's not directly to yourself. So again, coming back to this example, we found a property. I'll put some rough numbers out there. Let's say we're buying it for £100,000. Maybe we've got to put in £20,000 to refurbish the property, and after that, maybe it's worth £150,000. So the difference there is £30,000. That's the gross profit left in this particular transaction. And if we sell that, we can realise that £30,000 in gross profit. Again, this is a far more active way of investing in property because you will be viewing more properties typically than the first strategy. You'll also be managing the refurb or even doing the refurb yourselves if you're short on money, and that is what your skill set is in terms of building. So again, that's a very labour intensive exercise. And then also you'll be selling that property. And that sale could take, you could get very lucky, it could take 6 weeks, or you could be flipping it in an auction. But conversely, it could take 1 year to sell. Maybe, 1 in 3 sales on the open market fall through. And unfortunately, you could be 1 or 2 of those statistics, and it could take a year plus to sell. So inherently, there are different risks in exiting the strategy. Again, as I previously alluded to, you could actually finance as an exit. So you could switch to a long-term mortgage, again, another a 5-year fix, and prove to the mortgage company that you've added value to this property, and you could take out a mortgage based on this new valuation. And typically speaking, if you can do that and there's enough margin in the deal, 30% plus, you actually end up taking all your cash out if you get a 75% loan to value, which is great. Now, where these two strategies kind of cross over, and this is a really interesting point, and not a lot of people talk about this. A lot of people talk about getting all your cash out the deal. I think that's very short-sighted. It can be great at times, but there are some instances where that's just actually not going to make your life feasible. And what I mean by that is, let's say, for example, I'm going to use this example we've spoken about. We bought a property for £100,000. We spent £20,000 refurbing it, and it's worth £150,000. Now, if we take all the cash out of that deal and keep it and finance it, that net profit we're taking every single month minus the mortgage may actually be really small, especially if interest rates rise. And ultimately, that net profit could dwindle down to less than £100 a month. And is it really worth retaining a property, cash flow wise, for less than £100 a month? Especially if then someone else manages it, or even you have to manage it. Your time is worth far more than just netting £100 per month. Now, you could say, well, Marco, you haven't actually accounted for capital values and capital appreciation. Well, I understand that, but at the moment, end of 2022, I think capital appreciation, the outlook is pretty dire, no matter where you are in the UK. We're about to enter a recession. It's not like 5 years ago where you could quite easily attribute a 4 or 5% capital appreciation year on year, and that gives you another reason, another incentive to actually keep that building. Whereas now, for the next 5 years, I think a lot of people need to downvalue their capital forecast going forward. So, to recap, there are 2 main ways to earn an income through investment property. The first is more passive, where you slowly build a rental portfolio for the monthly cash flow, and that's what I really like. Secondly, it's a more active method. You're trading property, you're getting involved in property, your day-to-day life is pretty much revolved around property, which mine is. Now, I do both strategies, and I like both of them. But the second, you need to be a lot more well-versed and you need to be a lot more confident in your ability and your valuations to actually make money. I hope this video helps. If you've got value from today, please do let me know. And I kindly request that you subscribe to the channel. It's really going to help this channel explode. And I look forward to welcoming you to another video.